Hello. Well, as we start Q2, I think it's worth just having a reassessment of how the dollar is going to play out through the course of the rest of this quarter and indeed the rest of the year. And in a sense, I think we need to go back in order to try and estimate or assume as to where we're going to go throughout the rest of the year, because I think markets proved to be a little bit wrong-footed, including ourselves, in terms of anticipating a cheaper dollar from the start of the year. Because, of course, the US dollar has held in remarkably well during the first quarter of the year, far better than both ourselves at CIBC and most in the market had expected. And that comes despite the fact that the data has been relatively disappointing, despite the fact that the market has started to move to price in rate cuts through the course of this year. And, of course, we have had this period when we've seen a degree of curve inversion, not between 2 and 10 years, but between 3 months and 10 years. And, of course, that had raised red flags regarding the risks of a recession through the end of this year and into 2020. Well, I think those recession risks are rather overplayed. I think we're more likely to see a generalized deceleration in macro activity in the US through the course of this year and particularly into 2020. But I think that's going to have more of an impact in terms of Fed policy through the course of next year rather than this. But having said that, if we are going to see Federal Reserve inertia, the question is, what's going to be the impact in terms of the US inflation spectrum, and what's that going to do in terms of real yields? Because it was rising real yields that have proved to be one of the catalysts, certainly through the latter stages of last year, to provide support for the dollar. Well, if we are going to see the Fed being relatively relaxed about an uptick in inflationary expectations and inflationary pressures, and perhaps that's going to be partly a confluence of the rebound and uptick in the oil price, then it may well be the case that those real yields, which had been so supportive for the dollar, will become less so through the course of the next few months. I think beyond that, the ongoing situation as we move towards the presidential election in 2020, I think will become more of a concern for markets. And of course, we continue to have the pressure on the Federal Reserve from the president. Now, it seems to be the case that the president is now reconciling himself to be left with Chairman Powell as the Fed chair throughout the rest of this term and probably into his next term as well, should he win re-election. But it doesn't lessen the pressure on the Federal Reserve in terms of the political environment going forward. Now, I think one of the other reasons why the dollar has held up remarkably well during the first quarter of this year was the changing rate expectations that we've seen in other markets, in particular in Europe, but also in terms of some of those dollar block commodity currencies. Now, I think as we move through the second quarter and into the second half of the year, some of those rate expectations will start to change and start to deviate away from what we're seeing in the US. And I think that's going to provide increasing justification for investors to look outside of the US dollar spectrum. So you end up with the US dollar where interest rate or inflation expectations are moving higher. We have political risk starting to build. We have concerns about the fiscal deficit becoming amplified. And at the same time, we start to have a scenario where global trade tensions start to ease. Some of those rate cut expectations that have been amplified in places like Australia will start to diminish, and we start to get more of a constructive backdrop in the Eurozone, which also starts to make investors a little more wary about the pace and outlook of monetary policy in Europe. So I think the consequence of all of that is that those dollar bulls that were dollar bears, I should say, anticipating weakness in the first quarter, I think it was more an issue of timing rather than the policy prescription. And I think it is going to be the case that through the course of the second quarter, and particularly so into the second half of the year, we will see the US dollar losing ground, not just against the euro, but also against the yen, as perhaps the BOJ also continue their gradual progressive process of allowing yields to move higher, and the yield advantage for the US will become less beneficial and less impactful for those Japanese investors. So I think it is merely a case of timing rather than policy prescription in terms of anticipating a weaker dollar ahead.